Assalamualaikum, we are from Group 5, we're presenting about club. For the table of contents, first, introduction and tax treatment, which is we'll talk about a club. Second, principle of mutuality, which is between members and non-members. Third, accessibility of receipt, which is dealing with non-members on business activity, investment income, tax and scale rate. Lastly, exemption, which is about record keeping and tax filing. So, what is club? A club is formed are not for commercial purpose. It is for social, recreational, sport, art, science, literature or other leisure activity. It was established to benefit its members, but not for their financial benefit, and it was not formed for this commercial gain. Club can be included a joint management body, a management corporation, and resident association as community association for the property owners. Society Act 1966 governs the registration of clubs. A club is considered a body of person for income tax purpose. For example, photographer club, football club, and athletic club. Moving on to the tax treatment. A club is normally set up service for its member. Secondly, rely on the principle of mutuality for tax exemption. Lastly, members means persons who are entitled to vote at a general meeting of the club where effective control is exercised over its affairs.
The principle of mutuality. Principle of mutuality is a concept used in taxation where income from members of a mutual organization is not taxable. The principle distinguishes between dealings with members and non-members. So first, a member is someone who is registered to a vote, our general meeting. There are a few key points. First, surplus from members' contribution, if it exceeds expenses, is not taxed. Second, no profit from self-dealing. Legally, a person can trade with themselves, so member contribution or subscription are not seen as profit. And the last one is tax exemption only applies to dealing with members, such as their subscription or fees. The second point of principal mutuality is non-members. If the organization deals with non-members, the principle of mutuality does not apply. Any surplus income earned from non-members can be subjected to tax.
Thank you, Najmi, for the great presentation. Now I would like to present about accessibility of receipts, income from members and non-members. Club will have two sources of income, that is income from members and income from non-members. And income arise from transaction with members should not be taxable. This will include first, entrance fee and subscription receipt from members. 2. Provision of services to member for a fee. And number 3 is a sale of good to members. For the taxable is first, provision of trading facility for members. And second is cash donation. And expenses and capital allowance related to the income should be disregarded. A separate account of income derived from its member and non-member must be maintained and any losses must be disregarded. Next, income from non-members. Non-members are those persons who are not entitled to vote at general meeting of the club and society. Any dealing with non-members with regard to the following are treated as business income. That is first, fundraising activities. Second, rental received for hiring out of the facility or club hall to the public. Third, amount paid by non-members in attending social function, talk, presentation, and workshops. Fourth, trading activities. And lastly is proceed from non-members on charitable event. Remember, cash donation received from members and non-members is capital receipt and free from tax. Now, I would like to share about the computation of adjusted income from non-members. For the section 4A, that is gross income from non-members, less revenue expenses or outgoing or expenses incurred. That is formula A times by B divided by C, that A is common revenue expenses, times by B, that is common capital allowance, divided by C, that is gross income from transaction with non-members that can give adjusted income. After that, less capital allowance. The formula is D times by B divided by C, that D is gross income from transaction with members and non-members, times by B, common capital allowance, divided by C, gross income non-members. Then lastly, you can get the statutory income. Next, for the approved donation. Cash donation to an approved institution or organisation are entitled a deduction up to 10%. However, need to be apportioned. The formula is G times H divided by I. The G is cash donation under section 44(6) times by H aggregate income from taxation with non-members divided by I, that is aggregate income from taxation with members and non-members. That's all from me. I would like to pass this presentation to the next presenter. Thank you.
Next, I will explain about investment income in the context of club and association. Firstly, investment income such as interest and rent is accessible in the hand of the club. This means it will be subject to income tax. This principle is supported by the Case Management Corporation Strata Title No XYZ v CIT 1993, which is an important reference in Malaysian tax law. The court held that any rental or interest income received from non-member is taxable, and the mutuality principle does not apply in such cases. In simple terms, contributions from non-member are not treated the same as those from members. Lastly, dividends received by clubs are tax exempt under the single-tier dividend system. So no further tax is imposed on such income. Now, let's move on to how tax is computed for clubs dealing with both member and non-members. Firstly, dealing with member and non-member are treated as two distinct business sources. Revenue expenses that can be directly identified to either group can be wholly deducted from their respective income source. However, when revenue expenses are shared between both member and non-member, these are called common expenses. They must be apportioned based on gross income. The same principle applies to qualifying planned expenditure if these assets are used in both member and non-member activities. The expenses will also be similarly apportioned using the gross income. Here is a simplified formula used for tax computation. On the left, we have members' income. Section 4, subsection A, business income is calculated starting from gross income. After deducting allowable expenses, we get the adjusted income. Since club follow the mutuality principle for member, no tax is imposed on their statutory income. So, expenses, capital allowances, losses and donation are disregarded. On the right, we have non-members' income. First, direct revenue expenses are deducted, followed by common expenses and capital allowances, all apportioned based on gross income. The result is the statutory income, which is taxable. Add investment income to get the aggregate income. Finally, approved donations are deducted to arrive at the chargeable income. It is important to note that both member and non-member incomes are taxed at scale rates, but only non-member income is actually subject to tax.
Assalamualaikum and good morning to Sashah and my fellow friends. So today I will be presenting on tax exemptions for sports organizations, specifically under paragraph 26 of Schedule 6. We will start with the two types of organizations that qualify. Firstly, national amateur sport organizations. This must be certified by the President and Secretary of the Olympic Council of Malaysia and affiliated with the Council during the basis year of any year of assessment. So the organization must not only be recognized by the Olympic Council, but must also maintain its affiliation to continue enjoying the exemptions. Next, State Amateur Sports Organization. This is slightly different. It must be certified by the President or corresponding officer and the Secretary of a national level organization. Last but not least, it must be affiliated during the basis year to that national body. So in short, state level bodies need a formal link to a national level on that already meets the exemption criteria. proceed to the next slide, let's talk about record keeping and tax filing requirements. For record keeping, it's crucial that income from members and non-members is separately recorded. These records must be kept for 7 years, and this ensures transparent and helps if there's an audit or a review of tax-exempt status. As for tax filing, even though these organizations might enjoy exemptions, they are still required to file a tax return. The return must be furnished on or before 30 June in the following year of assessment, so compliance is still necessary despite the exemption. In summary, tax exemptions under paragraph 26, schedule 6 are available to both national and state amateur sports bodies as long as they meet certification and affiliation requirements. Proper record keeping and timely tax filing are essential to maintain this status.